So the reason we wanted to conduct this survey of brokers was to understand more how they're investing. You know, they're an important investor in the markets, and we found there wasn't much information available as to how they were positioning their portfolios, what they were trying to do for their clients, and the sort of outcomes they were trying to achieve. So, you know, the reason for conducting the survey was to get the information on just what they are trying to achieve in their portfolios. It's the second survey we've conducted. We conducted the first one in March this year. We sent this survey out just after reporting season in early September this year. And so, you know, we're just trying to understand how people are changing in terms of their view of markets and their portfolios. Some of the key differences from last time are an increase, which has been surprising, to be honest. It's happening so quickly, but it is consistent with the trends we're seeing, is an increase in advisors or brokers prioritising diversified portfolios for their clients and focusing less on absolute returns in terms of maximising performance. And that's something we're seeing anecdotally across the industry, you know, this movement from, you know, trying to maximise performance of portfolios to sort of build wealth, but also in a diversified way for clients. There's a few results that are, I guess, interesting that they're happening so quickly, but somewhat consistent with what we'd expect. And then there are a couple of surprises. So the things that are relatively consistent are an increase in use of global equities. So as brokers are looking to diversify their portfolios, one of the things we saw 6 months ago was that their portfolios were quite Australian equity heavy, and they've moved, and they're moving quite quickly towards global equities. And there's been a few high profile LICs in that 6 month period, which I think they've participated in, which has helped move the portfolios. One thing that was quite a surprise to us, we asked a question as to whether we thought brokers would have higher or lower returns over the next 3 years versus what they've achieved over the past 3 years. We initially were only going to ask the question, do you think that returns will be the same or lower, which reflects our bias because we're quite concerned. We obviously put the third question in, do you think that returns will potentially be higher? And twice as many people thought returns over the next 3 years would be higher than the returns we've seen over the past 3 years. So that was surprising that people are still quite bullish about markets. Brokers are constructing portfolios, and we saw this both in March as well as in September. They're constructing portfolios far more growth dominated than what we have. So, you know, in March, the average broker portfolio had 80% in equities. In September, it was still quite high at 75%. So clearly, you know, that view on higher returns continuing or even increasing from here is reflected in the portfolios they hold. We have been and remain very conservatively positioned. So we have less than 30% of our portfolio in equities compared to that position that the brokers have. Now, over that 6 month period, you know, the brokers have been right. We've been wrong. It was right to have more risk in the portfolio over the past 6 months. Equities, particularly global equities, have done very well. But we're trying to manage, you know, that balance of risk in terms of protecting the downside in our portfolio in a market that we think is quite expensive. So we're clearly more defensively positioned in our portfolios. So our current views and the way we build portfolios are driven primarily, or in the first instance, by our view on valuation. And our view is that valuations are stretched across almost all asset classes at the moment. Now, that's not a new view. We've held that view for most of this year, and as I said, it's probably been early, another word for wrong in the short term, to have that view on assets being expensive and being defensively positioned. But that's the first port of call in constructing a portfolio. We try and ascertain, are we being rewarded for the risk we're taking? And we haven't believed we have been, and that's why we've been defensively positioned. In terms of the economic environment, actually, it's been fine. You know, there's been enough growth in the economy, and there's been no signs of inflation, which has kept interest rates low and credit bountiful. And that really has been what has supported markets. In the absence of attractive valuations, that sort of cyclical tailwind has continued to push asset prices higher. So aside from valuation, a couple of the big risks are around inflation. So if we get an inflation surprise, which is possible later this year, early next year, that becomes problematic for interest rates, bond markets and bond sensitives. That's one of the two kind of supporting pillars of this great cyclical environment, growth being robust and inflation being benign. If inflation picks up, then that could be problematic. It's not necessarily an unknown risk. People are aware of it and looking at it, but it is a potential risk to portfolios. The other, of course, are left field risks that have a low probability of occurring, but a significant impact on portfolios. So whether it's a geopolitical event like North Korea, which obviously is well monitored, or something like China, which obviously the Australian economy has a lot of leverage too, and the current view is that there's not a lot of risk in China. If that changes, if the financial leverage in China becomes problematic, that could have a material impact. So at the moment, it's a low probability event, but it could have a significant impact on client portfolios. So there are a couple of the things away from valuation that we're sort of concerned about from a left field perspective.